So in this video, I'm going to cover how I read the key spreadsheet metrics so as to accumulate and distribute positions, as well as trying to hang on to exposure during the AI mania, which has been hard to do. I've already sold out of Clack, Amit. All whilst we wait for the S&P Nothing Burger to top, so it can herald a correction of about 20%, which is doable. 20% should be doable. Where would 20% take? Say if it tops at 7,700, 20% would take it below 6,300 towards 6,000. 20% should be doable. Already got a 21% drop. So while we're waiting for that to manifest, it just keeps climbing. Oh, it could have topped here. Could have topped here. 150% of the range. Could have topped here. Another range. And now we're at 200% of the Ranwo range. 7,700. It keeps climbing. So whilst we're waiting for the top for further buying opportunities, I'll show you how the metrics work. But first, how is my 76% in cash portfolio beating or matching the S&P? Yeah, I'm 76% in cash. You know what that means? It means there's no drawdown. Yeah, well, this is my current state of my portfolio. Pumping, now it's pumping, IBM's pumping. This illustrates how. Let's see how it's performed. This is my largest account and interactive broker. Year to date is up 9.15% versus the S&P 10.7%. And if you notice, without no drawdown. When the S&P was down 7%, I was still up about 1%. So how am I doing this? Well, I would have just shown you by accumulating, distributing. What about the performance over a year? Again, beating the S&P over a year is 33% versus 28% S&P without the drawdowns. That's a function of high cash percentage and the function of accumulating and distributing. So what about versus the Nasdaq? I'm not going to be beating the Nasdaq. There's no chance. No chance. Yeah, look, it's beaten. But look at the drawdown Nasdaq. It was down 10%. Now it's up 16 versus mine up 9. You know, that here, folk who had not failed to sell would have been depressed. Whereas I'm accumulating as it dropped to then distribute as it went up. Right, so how am I doing this? How am I beating the S&P or matching it without the drawdown? Pain. Let's have a look. I will show you now. I'll show you. 1 year, year to date, neck and neck. All it takes is, if the S&P fell 20%, I would still be up on the year. I would still be up. And it's even better than it looks here, because the S&P is in US dollars. So this gain is 10.7% in US dollars, whereas my account is in sterling, British pounds. You know, UK investors will understand what that means, because as stocks go up, the dollar tends to fall, which means it falls in sterling terms. So it's impossible for most folk to even come anywhere near 10.7%, even if they invest in the ETF, S&P tracking ETF, they would be down, they would be up maybe 8% because of FX. FX works against foreign investors, because when stocks fall, sterling falls, so you're able to buy less US stocks, and as stocks go up, sterling goes up. So when you sell, you get less pounds back because the dollar's gone down. So how am I able to do this? Let's have a look. Let's have a look. Some of the stocks that have enabled me to beat and or match the S&P by accumulating what drops. Look, here's one that's I'm accumulating right now. Look how much it's dropped to the low, 57%. So accumulating this is not pumped yet, but it will do, and when it does pump into it, we'll get to a doubling. So it's a 2x. So accumulating here for a 2x. What about the next one? CRM, Salesforce. Again, it is dumped. Look at that. That's had a spectacular dump. Again, accumulating at a 55% drawdown. Even now it's down 48%. From here it could eventually first get target for a 50% increase to 268, and eventually to a new all-time high, which is a 110% increase. What about something that actually has taken off? IBM. Accumulating here on about 30, I think it was about 30% drop. Yeah, 33% drop, and now it just took off. It's took off like a rocket. On the last close it was 300, but it's actually trading right now as I'm doing this video, it's trading at up to 340, 60% off its low. So accumulating here and distributing after 50% gain is what's lifting my portfolio. Let's look at another stock that's I was buying, patrons were buying along with me. Here, look, it dropped into February 40%, and now what has it gone up? So 112%, more than doubled. So accumulate, distribute. You can see what I hold here. Look at the bottom. Stocks mentioned in the comments from time to time. There's now ServiceNow, the large holdings, Snow. They're all there. CRM. 132% exposure. FICO. Let's look at FICO. What's FICO doing? It's a large holding. Yeah, it had a spectacular drop. Look at that. That's spectacular. 63%. And it's I've only just started trimming this on its 50% gain. It's up 50% from the low. And the lowest buy was actually, yeah, it was around 872. And you're making 50%. This is how I'm beating S&P, not by staying invested, but by accumulating what drops significantly and then trimming as they go up 50%, 100% more. Let's look at another one, CrowdStrike. Oh, I looked at CrowdStrike. I'm not sure. Oh yeah, we looked at. Okay, let's look at what Microsoft, big name. What's it? AI Primary. That had a spectacular drop to dirt cheap. It's still dirt cheap. It's gone up to 450 now. I would still class it as cheap, not dirt cheap, but look, it fell 33%, and look how much it's up from the low, 26%. I wouldn't start trimming until about 480. Not Microsoft. What about Meta? Meta fell a lot. Yeah, look, there's Meta. It fell 34%. It's currently up 20%. I would start trimming a little bit here around 680. Small trims, larger trims over 700, around 730, and then a new all-time high. And if it drops, I'll keep accumulating. So they're the two big primary ones that have dropped. There's IBM that took off, and then there's the software stocks such as Snow. Look at this is nuts. This is nuts. Fell 60%. And, you know, in a blink of an eye, it's shot 120%. In a blink of an eye, investing terms, that is a blink of an eye. If you got scared there and failed to accumulate, it's your own fault. You know, you missed the opportunity. 50 whilst you're staying in the S&P, these opportunities are coming along. This is what's pushing up my portfolio despite being 76% in cash. Let's look at another one now. That's just only now starting to take off. It's only now taking off. It's already up 100. It was 136 current price. Look, it's already took off, and folk had plenty of time to accumulate sub 100. This is how I'm beating S&P, or matching it despite being 76% cash. Another one, SMCI. Look, it's took off. Yeah, a spectacular fall. Well, let's do it from here. From 58, it fell 65%. And how much is it up? It's already past 2x, on its way to 3x. So people staring at S&P are just missing all the opportunities. SPGI, let's look at another one. They're accumulating. Yeah, this one is yet to blast off, but when it does, it's from here, it's down 30%, and when it recovers, it'll be up 36%. That's for a low volatility stock. What about one of the old portfolio stocks that have been dead for years? Look at this one. It fell 63%, and it's recovered all of it, and it's trading at a new all-time high, up 200%. It's not, that's a 3x. GFS has done a 3x off the low. 2x would be here 100%. It's done a 3x. Another one on semi. Another one. All of these flagged in the comments. These are like have been dead for ages. People wanting to sell out. That's 71% drop. That would have been painful. I'm not saying it wasn't painful to hold during all this drawdown, because folk who accumulated during 2022 would have been, yeah, where's 2022? Yeah, look, you would have accumulated between about 80 and 50. So you would be in drawdown. I was in drawdown. Everybody was in drawdown. So if you take it from 8, say average of 66, that's a 2x. So taking the average that people would accumulate at around 66, that's a 2x. Another one, so we look at another old one, diode. So another one that failed to perform. It dropped from the high to the low. Ooh, look, 70%. Very painful. The average would have been, for most, I'd guess around $70. So from 70, there's a 50% drawdown. And now it's flipped from a 50% drawdown to a 70% gain, and it's up 250% from the low. What does that mean? That means not only have you recovered the whole of your drawdown, but you've matched it and more on the way up. 60-70% gains, trimming as it goes up, reducing exposure, turning negative into positive cash on the portfolio, lifting the average. This is how I've been. This is why despite being 76% in cash, it's matching the S&P, which is 100% invested ETF. With that, this is why I don't get the drawdown. You don't experience the drawdown. There's no drawdown. So when the S&P drops, yeah, I'm not going to be down on the year. When it drops 20%, 30%, even 30% won't see me down on the year. I don't think so, no. Not when I'm 76% in cash. It's going to take something like 40% drop in the S&P for me to be virtually on the edge of being down on the year. No, it's 4 times. At least if I'm only 24% invested, it has to be 4 times at least. And that's if what I hold a lot of drops. Yeah? Because if I hold a lot of like Now and FICO, they're already down. Yeah, so there's not much downside there. It could go back down to where it was, but we're already trimmed a little bit, so I might not accumulate much given what I hold, but the downside is limited because already 63%, being 63% off its high, so the potential downside is limited versus other stocks such as Micron, or they could lose 70%. Micron could lose 70%, of which I hold none because I've sold out. Number of stocks like Intel could give back. There's another one, Intel. This was in a bad bear market, down 73%. I'd guess most people's average by, if they accumulated during 2022, I think the average would be around 38, which is fair. So from 38 to the low is 50% drawdown. My average was around, I think, about 36 point something. So I had a 50% drawdown. And since then, AI Mania, 600% off the low, and from the drawdown, 38, 250%, going on 3x. And I started, obviously, you're not going to sell everything at the top, but I still hold a small amount of Intel. So that's how I'm matching the S&P across the spectrum, from stocks that I just recently bought, in February, the crash software stocks, to stocks that I've held for years that have been in a severe bear market, such as Intel, and stocks that I've range traded, and other stocks that I've accumulated and distributed, such as Google. I still hold a fair chunk of Google, not trying to stay invested, such as trimming here, accumulating here, trimming here, accumulating here, before it took off. Now trimming a little bit here and seeking to accumulate around 340, maybe down to 275 if you get lucky, because it is honest, as I often say about Google, you want to be careful about selling Google because it is on a stairway to heaven. Google, let's see how much I hold of that. Alright, so let's get back to the spreadsheet on how to read the metrics, which is the primary focus of this video. We start with Nvidia. Last price 2011. These are the metrics, the main ones. You can ignore the ones on the left. Everything plays a role. Yeah, exposure, hard cash invested, percentage change year to date, deviation from the high, deviation versus 2021. They all play a role, but the main ones are the EGFs, earnings growth factor. We can look at the investing guide that explains what it's all about, which is, and this spreadsheet is available to patrons. The link is always in the most recent article, and I also put a link when people ask in the comments, if they don't want to search the article for the link. But it's in every article. So what's the metrics here? Let's start with NVIDIA. Okay, so earnings. And I always look at the metrics on it before the charts because it's quicker. The metrics tell you instantly where things are. We start with the EGFs. There's the earnings growth factor. There's current and forward 12 month. And then we have the direction of travel of EGFs on previous readings, like 17th of April, before an earnings season. So this tells you what the current EGF is, this one, versus the previous. Is it accelerating or declining? Basically you want all these to be blue, to be firing on all cylinders, where this one is the most important. The first one, then that one, then these. And then in addition to that, we have the P percentage of range, which tells you if a stock is expensive or cheap, current and forward. And we also have a FOMO factor, which is less important. That just tells you the difference between these two, because forward P, a year forward, is less reliable. You want trailing is most important, because this could evaporate. Something could happen and earnings fail to evaporate. But it gives some clue. Right, so let's use NVIDIA for example. What's it say about NVIDIA? It says it's got very strong earnings growth, current and forward, but earnings are weakening versus the previous. In terms of P for range, it's not expensive, 72%, and it becomes cheap a year forward. So what does this say? It says for NVIDIA, you should continue to hold NVIDIA even if you expect it to drop by 30% to 140. You should not sell what you hold. You should always retain some. Trim a little bit on a new all-time high, but do not go to zero, because earnings are making the stock cheaper over time. So you're paying it by selling out or selling too much. You're playing a dangerous game that you might not be able to buy back in. And you don't want to get too greedy with the drops. 20% drop. I bought some on that, and which I've trimmed now. I should have bought more, but that's hindsight for you. Like, this was a pretty decent drop, 40%. You can fantasize about getting that here, which would have taken us to here. Oh, we didn't get it. 130, that would have been like a fantasy figure. I was more seeking something like that, but I was accumulating from 177. So that tells you, the metrics tell you, without looking at the chart, what you should do. Right, my voice is going. Let's try and get this done. Google, what's that say? Let's go that. Oh, good earnings growth, good forward, and look at that. It's accelerating. That means Google is very strong. It's expensive, 107%, which is going to hold the stock price back. Yeah, it's not going to shoot off like a rocket because it's expensive, but it will get cheaper over time, and its earnings are accelerating. So you want to hold a sizable chunk of Google. Even if you expect it to drop, let's go now look at Google. There we go, let's Google up. See? If you get it's correcting because it is expensive, but the correction is going to prove short-lived, and it might not get below 340. If you get lucky, it drops to 270 again. Like this correction was 22%, so if you get 22% off here, yeah, to around 300 at best, but I would start accumulating from around 340, which is not far from 376, because it is firing on all four cylinders. Yeah, and it drops, and its P range drops a year forward to 8%. So you want to hold on to Google because it's climbing the stairway to heaven. What about AMD? That is nuts. It's got epic, even stronger earnings than Nvidia, but it is slowing. It is slowing, and it is very expensive at 277%, which drops to 107%. So I've sold out AMD. I can't hold on to a stock that's trading at 277% of its P range. And you all probably know how its stock price is done. It's took off like a rocket. Literally took off like a rocket. And I can't hold on to it. Look at that. From 200, by 300 I was out. And that was like 160% of his P range. It's now nuts. It's nuts. It's AI FOMO mania. 277%, that is nuts. And the thing is, when you got a portfolio, unlike an index like S&P ETF, you don't have to be invested in every stock. You only have to invest those that are high probability plays. You know, they're not ridiculously priced, which is why I'm zero now, because it's ridiculous. Let's look at Microsoft. Yeah, earnings growth is not that strong, but it's there. Some weakening, but the main thing is it's still cheap. It's 50% current and minus 16% forward. That means Microsoft is a low risk stock. You know, if you go here and look at Microsoft chart, yeah, it's down 35, fell by 35%. Excellent buying opportunity at 350. Now it's already up 26% off the high. In fact, right now it's surging towards, I think it's gone up to 480 latest price. Microsoft 460 current price. 450, yeah. So it has gone up a little bit. Up 30%. So it's virtually, it fell 35%, it's up nearly 35%. So this is a good one to accumulate sub 400 or maybe even below 450 if you're holding on, because it has got strong earnings growth and it's not expensive. 50% of its range is fair value. It's not expensive, not cheap. It was cheap, but that's it. Let's look at Meta. Oh, Meta. Weak. First red on the current, and it's a small growth on the forward. You can see the weakening here. So you can see Meta is weakening. It's fair value, but it doesn't, because earnings are weakening. This has got the potential to have a severe bear market. Yeah, it fell 34% and it could go up to 730 as a correction. It's currently up 20%. I think it's got potential to drop below 480. It could, you know, this could drop below 400. 50% drop. And I can see this from the metrics just by looking at -6 current, 11% forward, weakening direction of travel for both 16th December earnings and 17th April earnings. It's just for direction of travel, and so that means Meta could be heading for negative earnings, which would make the P range more expensive. I hold a lot of Meta by virtue of the fact that I bought a lot of Meta during the 22 bear market. So even though I've been trimming like crazy during the rally, it's gone up so much, 8x off its low, that despite heavy trimming, I've still got a huge position, 1.8% versus everything else, and I can let it ride because I've still got plenty of capacity to buy. Next one, TSMC, that I'm out. I class this as a big mistake. I should not have gone to zero. Look at that, 19% current, that is strong, and forward is strong. Yeah, that they don't matter. Not when you got this amount of strength. It's when it's borderline that it matters, like with Meta, because you're going negative. But it is expensive, 129%. I would rather hold Google. Yeah. So it's a toss up. You know, which one are you going to focus on? Yeah, it is expensive, but it's got stronger earnings growth, but Google is stronger in the present, and cheaper. So Google is the better bet. This is going to be more volatile. Let's see what the stock price is like. TSMC. Look at that, it's shot up like a rocket. Its downside, it's got not more, about 20% to 300, 320. So it could fall $100, but it is strong. What about the next one? That's Qualcomm. Oh, this one. This one is a dog. 4 reds. The first stock with 4 reds. And it took off like a rocket. 81%, rising to 90%. It's got negative earnings. This is so. If there's one stock that's in forma that folks should trim, is Qualcomm. I've sold 60% of what I held. 60. This was 100%. Now it's 13% invested, and I'm continuing to trim as it goes up. Let's look at the Qualcomm chart. The metrics say it's a dog, but at the current valuation, look at that. It took off like a rocket. Accumulated on the drop. So let's take it off this high. 40% drop off the October 2025 high, and it has completely taken off like a rocket on Mania. Doubled. Forker made 100% on this by accumulating sub 150 and then trimming, and you've had 2 opps to trim. You trimmed on the run to 248, it dropped. I won't say I would have bought any here. I didn't buy any here. I would seek sub 170 to accumulate, which would give me from here 34% discount off selling at the high. I sold some at 258, but the metrics say it's a dog. This I understood why it traded down to 120. Remember, this is why the S&P is moving off to a new all-time high. It's trading because the metrics saying it's a dog, but it's a primary, and it was cheap at 120. If you change the price to 120, you can see what the P range drops to. At 120, the P range was 6% cheap, dirt cheap. At 140, it was dirt cheap, 17%. Anything below 20% is dirt cheap. Now, at 251, it is, anything above 80% is expensive. For Qualcomm, if this gets to 100%, that is like 100% of this is equivalent to 150% of Google. Google is cheaper at 107%, and Qualcomm is cheaper at 81%. Because of these metrics. So that's the primaries. Anything else? Look at other one that sticks out. I'm not going to go through all of them because I'll be here for hours. Let's have a look. Broadcom. Look, this is excellent. Strong, very strong, but it's expensive. But I would be wary of going to zero. I have sold too much Qualcomm. No, I mean Broadcom. Let's look at Broadcom. There we go. Look, and it gave us a decent 30% drop to accumulate on that I've now trimmed on this pump. It is you should not go to zero. I sold too much. You should not go to zero because the metrics are so good. Even though it's expensive. What about Tesla? Tesla, that piece of crap. Look at this. It's got negative earnings. Tesla's got negative. Forward is 27, but like I say, you should not put too much on forward. Focus on primary and look at the P range, 500%. That is ridiculous. Tesla is a ridiculous stock. This is why I hold none. I'm short. I've accumulated a short position above. I think my average is around 420. A short position via minus 1x ETF. It's pumping now, and while it's pumping, I'm adding to shorts because it's ridiculous. It's gone nowhere for 5 years. Look, it's gone nowhere for 5 years. You can see that because that's the metrics. They tell you it's garbage. Yeah, you can make money if you buy it cheap, and because you know the FOMO crowd are going to 2x it. Yeah, if you buy it under 250, then you get a good pump. If you accumulate under 250 to 500, that's a 2x. Yeah, that's okay, as long as you're prepared for the potential drawdown. So I think the metrics are screaming that Tesla's going to drop from here. It's going to go below 300. It's going to go below 250. It's going to go back down to here. It's already been here once. It's going to go there. That's a 50% drop. That's what the metrics say. That's why it's my biggest short, Tesla. Via minus 1x ETF, not leverage, because leverage will kill you. If I'd been leveraged, I'd have no chance of making money because I've been accumulating a short over 400 for some time. Trimming here, accumulating here, look here. Accumulating here and trimming when it fell here. Trimmed some of my short, maybe 10%. Now I'm adding again because it is going to go. The metrics are clear. 500%. Are you joking? Were you smoking? And the weakening. Not only is Tesla's negative, but the weakening. It's not even getting stronger. And it's expensive. What else you look at? You look at IBM. That's took off. Yes, it's got weak. It's informal. It was cheap. Now it's become expensive. It's got weakening earnings. It's got weakening earnings and it's now expensive. It was cheap. I think it fell down to 212, something like that. 212. It was. Where am I? 212. It was down to 50% of his P range. Not dirt cheap, but worth accumulating when there's nothing else to accumulate. But now it's took off like a rocket. Like I said, I just trimmed some at 344, I think. Because it's took off like a rocket. It's took off to a new all-time high. Trading up 60% from its low. It literally has taken off like a rocket. It was down here. I was accumulating here, accumulating, and it just took off. I was hoping that the bad metrics would send it lower to around maybe 170 to add some more. So I didn't accumulate as much as I was hoping for, but you know, those who were waiting for the low accumulated nothing. And now it's up 60%, and I'm trimming. I've been trimming since 300, within 10% of its all-time high. From about 292, I've been trimming and trimming, and as it's good, I've been trimming. Not a lot, because I am 76% cash, so I don't want to disinvest from IBM. I want to capitalize on it, but I don't want to disinvest. Anyway, that's how I read the metrics. What else is there? Shall we look at the other? What sticks out? Western Digital. That's another. That's took off like a rocket, but very expensive. Diode I've covered. That has got very strong metrics, but it's took off like a rocket. P range has gone nuts. but the earnings are blasted off. On semi, see, all of these are expensive, and I've sold out, and I had a large position. Autodesk is the one that looks cheap. It hasn't got very strong earnings, but it's cheap. It's worth accumulating. 11% minus. If you look at Autodesk, that tells me, hey, look, Autodesk accumulate, and I've been accumulating. I'm 87% invested. 87%, 0.8%. It's gone up a little bit today, but it is cheap. So let's look at that as the last stock. Like I said, this spreadsheet is available to patrons, and the link's in the latest article. Look at that. It fell from the high to the low, 34%. It's up a little bit. I would accumulate all the way down as far as it'll fall. If it fell to 166, I would buy a lot. I don't think it'll go that low. I think it might get down to around 190. It might get down, which off the current price, that would be a 40% bear market. Off the current price, it's around a 15% drop. So, you know, if you don't hold any, you should accumulate right now some. As it drops, add, like order, accumulate. As it drops, buy more. And then as it pumps, trim it. So if you accumulated here, you know, you start trimming around 280, 30% gain, start trimming some more as it approaches its all-time 50% gain. You know? That's how I read the metrics in the spreadsheet, and the links in the latest article and in the comments if people ask. If I can't bother to search the article, I update the link to the spreadsheet once every 3 months, 3 or 4 months. So it's not like every week. It's once every 3 or 4 months because it's only meant for patron access. So that's how I read the articles. Do check out my latest article and do consider becoming a patron by supporting my work for just $9 a month. You get a lot for that. You get investing guide, which is condensed investing guide, and the videos such as this. And now I've added the stock briefs. You know, the latest one, like for instance Netflix. Accumulate, growing earnings in a bear market, accumulate sub 88 down to 70 for an eventual new all-time high above 134. I update these from time to time. But single one-line briefs, which is my latest edition. For Nvidia, dip buy, very strong earnings growth is making the stock cheaper over time. Strong earnings, failing to pump. What's that mean? Strong earnings. Alright, saying strong earnings are failing to make the stock price pump. Suggests a dip is probable. Aim to accumulate sub 190. And my voice is going. See, look, I even tell you what I've just told you. So not only have you got the metrics, yeah, that tells you the state of play and how to read them, but I've also condensed it down to one line. Like say, lightly trim Google, very good trend, not expensive, don't trim too much. For Microsoft, for Meta, I said it's could go to a new low. Strong earnings growth, but now we don't buy too high. Destined to new bear market lows below 520. Qualcomm sell, weak earnings, volatile. So it's all there, all in the spreadsheet, updated as time permits, and we've got the live spreadsheet, current metrics, which you should try and learn to read. It's not complicated. It's straightforward, so you can read it at a glance. The colour, you got 4 blues firing on all cylinders, 4 reds misfiring on all cylinders. Qualcomm. So if you hold a lot of Qualcomm and you're not trimming, you're asking for trouble. Seriously. Yeah, it's not expensive, but that's not expensive for a reason. It's because it's got weak earnings. So you don't want to be seduced. So it's not one thing like PE range. It's all these 4 and these 2, these 6. There are other metrics as a dilution, but yeah, you take note of for earnings growth. See, this is why you don't want to. You want to accumulate as it drops, because they do buy back shares, so earnings will rise over time. Same with Meta, same with Google. It's AMD that's the wild card. That's gone nuts. This is why I've sold out. They print shares. Another heavy printer is one of the reasons why Apple's gone up is because they buy back shares a lot. Clack also has gone up a lot because they buy back shares a lot. Lam Research apparently. AVGO prints, but their earnings growth is so powerful that it doesn't matter. But AMD is the outlier here. They could give, I think AMD is going to give up 80% of its gain. So at 500, it could drop to 100. That's not my base case, but base case I think around 150. It is nuts. It's gone nuts for more. Natural. Anyway, do check out my latest article, and do consider becoming a patron for just $9 per month, which is nothing. $9. That's nothing. Nearly 1/3 of that goes to on the fees and stuff. So I only get about $6, which is the price of a very cheap martini. And soon, with the inflation that's in the pipeline, those martinis are going to become pretty expensive. But I'll keep it at $9. Don't worry, I'm not gonna inflate it. As long as that covers the fees, most of the fees, 1/3. That's alright. I'm okay. And this video is a mere fraction of my extensive analysis that is first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $9 per month, which is nothing compared to what you get access to. I try to do best by my patrons. Folk only need to go read my articles open to the public and the literal thousands of comments under them. Look at this one, 2,200, nearly 2,300 comments under this article, which shows the level of engagement with patrons. Keep calm and carry on buying AI tech stocks as they deviate from their highs. Where the greater the deviation, then the greater the buying opportunity presented. Keep calm and carry on buying. Quantum AI tech stocks. Access to my latest mega analysis, a comprehensive 3-part guide on how to really get rich during 2020. That has exclusively been made available to patrons right now. You can go and read the 3 guides right now, full access, which is a truly epic piece of work that took me the whole of 2023 to write, which condenses down my lifetime knowledge and experience down to some 60 chapters, which is on top of my ongoing analysis and trend forecasts that are made available to patrons for just $1 per month. There are no bolt-on extras, no courses, no other crap that all these con merchants do. You get full access to everything. So, did you buy the October 22 bloodbath, especially in tech stocks, fangs, with the likes of Meta plunging below $100? Well, I and my patrons did. Go read my articles and the comments posted under them. We got well blooded by catching all those falling knives. Did you make the mistake of listening to the likes of Clown Kramer on the Cartoon Network? who stated Meta, amongst others, was finished. Meta finished at $100 a share. It was the mother of all buying opportunities. This clown stated it was finished. Says it all about Clown Kramer and the Cartoon Network.
They're finished. They're finished as places.
They're finished. They're finished as
places to invest.
We keep talking about this falling knife, as if the knife continues to fall. Though there are people who look at this and say,
look, I'm looking at the money coming out. Where's the money coming from to buy to buy industrials? It certainly isn't coming from new people saying, "Wow, it's time to put money in the stock market," because they get such a great rate on the 2-year. I think it's money coming rotating out of companies that have dominated this market for the last decade and into companies like Caterpillar who actually know what the hell they're doing.
Are you thinking that the tech companies that I think that you're disappointed in are going to get religion, if you will, and get disciplined? And what does discipline look like?
You know what they are? I would call them atheists. They believe in nothing.
That's a nihilist.
Meta? I don't know. I think they have to change the name again. They really do. I mean, you can't be saying Meta. I don't know. How about loser? How about stupuda? I don't know. Anything doesn't even matter. I don't know if they can make a comeback. The facts have changed, and I have to change with it. I believed. I thought I'd be safe. I was wrong. Bottom line, forget being leaders. Big stocks are now followers in a post-COVID era, where we're learning that their earnings were far more inflated by the pandemic than we knew. We're just now discovering that tech emperors have no clothes, if they're even emperors at all.
So at least give it a try. Read the comments, see the depth of analysis. You won't be sorry because I do my best by my patrons. Go that extra mile. Gaining access to over 35 years experience. Right from before the 1987 crash, straight through to this stock's bear market. That we ride the quantum AI megatrend into the future.